Good morning, everyone. Welcome to this very exciting and needed webinar on navigating and the roles of tools and taxonomies for investing in adaptation and resilience. I'm Sarah Schaff. I'm with Gary, the Global Adaptation and Resilience Investment Working Group. This webinar is part of our implementation of the CALE program, which is funded by the Global Environmental Facility through UNIDO, along with a few other partners. So we're so happy to have so many of you here today, and a number of experts who are going to be able to talk us through their real world experience in implementing tools and taxonomies, navigating them through quite a few years of what it's meant to invest for adaptation and resilience in some really practical ways. So I'm really thankful to have all of them here today. And we're just going to jump in to try to maximize as much content as possible in this hour that we have. As you have questions, please enter them in the chat. We will probably get to them sort of towards the end. Some of my Q&A is a little bit flexible depending on the interests of this group, but we're going to give each of our panelists the opportunity to present a little bit about themselves, the organization that they work for, their perspective and experience on implementing these tools and taxonomies. So with that, we are going to kick it off with Morgan from the Climate Policy Initiative. Let me see if I can get you pinned up here, and I will share your slides.
Great. Thanks, Sarah. While you're sharing, I'm happy to introduce myself. Hi, all. Good morning and good afternoon. I'm Morgan Richmond. I work at Climate Policy Initiative, as Sarah said, and in this intro, we'll walk through two examples of the way that we leverage and see others use and leverage adaptation taxonomies and tools in our work at CPI. One from the perspective of our work tracking post hoc financial flows, and then one from the opposite side of the ledger supporting teams as they structure financial vehicles to invest in adaptation. And on the next slide, so first, we've been tracking adaptation finance since the release of CPI's flagship report, The Global Landscape of Climate Finance in 2012. Since its release more than a decade ago, the Global Landscape offers comprehensive global overview of climate finance flows. And the purpose of this slide and the ones that follow is that in more recent work, we've begun to improve the way we track adaptation finance from the private sector very incrementally. So you can see here, this is from 2023, we tracked a small amount of private finance circled or squared in yellow. But even still, even as we were improving the tracking, the amount of finance that we were able to track remained perilously close to zero. And in the as sort of brief context for why this mattered and why we were thinking about taxonomy use, in the midst of this gap in tracking, we know that we're not actually capturing all that exists in the real economy. And we know that limited private sector adaptation finance data and reporting feeds the common narrative that others will talk about too, that there are limited or no business models available for adaptation. And we know that that's not true based on our own work with teams structuring adaptation financial instruments. We know it from seeing the market. And yet in conversations with private investors, we're frequently encountering the misperception that all of adaptation was non-commercial. And so on the next slide, the use of taxonomy informed by this gap, what we set out to do with this work is to shift the narrative on private adaptation finance through evidence-based data analysis of capital flows. And part of this effort involved the development of a comprehensive taxonomy of adaptation finance. I won't get to everything on this slide in the interest of time, but just wanted to sort of put it on the table. This taxonomy built on existing efforts and serves as, for us, the foundation for better tracking of private adaptation finance and sort of integrating with wider climate finance tracking. We really tried to be thoughtful about the way that this taxonomy aligned with other taxonomies in the field and other organizations who are leading on this. So worked closely with Climate Bonds Initiative and Tailwind and others to think about the way that these taxonomies could be fit for purpose for different purposes, but as aligned as possible. And our aim was that this taxonomy, this particular taxonomy, would be useful for private actors to offer consistency and clarity around identifying and classifying 1,300 plus climate relevant activities across 7 themes. And the view that's here is of a particular one activity, which was desalination. across the sort of themes and categories of the taxonomy. Like I said, in the interest of time, I won't walk through it all, but we'll put it on the table that it's here and note that sort of happy to talk about it more in the discussion. And the yellow here is flagging one piece of this taxonomy that was relatively new, which was this adaptation likelihood capture to evaluate projects where the intent and climate relevant risks are not reported in the financial flows. So that's this. The context or the outcome of this taxonomy on the next slide is that it became part of a classification model, batch data process. And again, I won't walk through all that's on this slide, but in partnership with Vibrant Data Labs, we collected data. A subset was then tagged according to the taxonomy. It facilitated model training, and the tagged data then fed into this classification model development stage, where a machine learning model was developed to classify project companies and funds according to the taxonomy. And on the next slide, the results of this flowchart of data processing is that we now have nearly quintupled the amount of private adaptation finance that we're able to track. We're able to identify adaptation investment flows that relate at a far more granular level. And like I said, in the interest of time, I won't go into specifics except to note that we've significantly advanced our understanding, especially of finance from corporations, private equity, asset managers, and commercial banks. So that was the sort of end result, more or less, of this taxonomy development. The vision is that this taxonomy is iterative and not a final product, and that it can continue to develop over time. Then to the second example, that taxonomy development is at the sort of post hoc tracking level. On the other end of the finance life cycle, we also work with adaptation taxonomy with teams on the next slide, very early in their structuring financing approaches. So CPI is the secretariat of the Global Innovation Lab for Climate Finance. It's a program that accelerates and stress tests financial vehicles. We've supported 78 financial vehicle teams over about 10 years, including the Lightsmith team through Craft that several folks on this call work on much more closely than I do and can speak to. About 20 have had a central focus on adaptation, and those instruments have collectively mobilized more than $500 million, which is what's reflected on this slide. And to wrap on the next slide, one of the areas of support that we provide for these teams is thinking about managing climate risk and, when relevant, building an adaptation and resilience strategy. And this is another place that taxonomy and tools come in, and then I'm happy to talk about more in the follow-on discussion. Sort of three core goals for this work around helping all teams at a baseline align best practices for assessing what climate risks affect them and their pipeline and developing a strategy for managing that risk. And then for those that are targeting adaptation resilience outcomes, helping them think through the evidence case that their approach is specifically responding to climate hazards, and then has a direct strategy to build resilience and a strategy for impact measurement and reporting that's fit for their purpose, for the purpose of their pipeline and the purpose of their investors. And really critical to goals 2 and 3 is to think through what taxonomies and tools are useful to them. And it really varies. So I won't go into specifics for now, but that's sort of a table setting of two examples from the post hoc tracking lens and then from the supporting of financial vehicles structuring lens of the way that we think about this. And with that, I will pass it back to Sarah.
Thanks, Morgan. I think it was a great kickoff to acknowledge, even within the work that you all do, there are these two different pieces of it. There are these two different pieces. There's just the ability to track, which has informed the way that you've developed the taxonomy, responding to the needs for it to respond more to the private sector, the fact that there was obviously investment from the private sector that just wasn't being tracked, and there's been more investment. And so the way that you kind of developed or evolved the taxonomy over time from a tracking tool, but then also that other side of how do you actually develop frameworks, structures, investment vehicles for the explicit purpose of adaptation and resilience. There's a different set of tools that are kind of needed on that side. So I think setting up that when we're talking about tools and taxonomies, we're going to be talking across when investment happens. Are we tracking? Are we designing? Stages of companies or something that we're going to start to talk to. So thank you for covering that piece. That was really useful. So we are going to now jump over to Anna from Climate Bonds Initiative. So Climate Bonds Initiative, CBI, I'm probably going to mess up saying CBI and CPI on this call a couple of times. I'm going to try to get it straight. So CBI also has developed their own taxonomy that's being very widely used. Obviously, the word bonds, we're thinking about the debt market, explicitly bond market. The taxonomy itself was developed for the bond market, but it's being used. across private investment. So, Anna, can you give us an introduction to yourself and CBI, the work that CBI does, and specifically that taxonomy, and let me know if and when you need me to share any slides.
Brilliant, thank you. Yes, everybody, I haven't got slides, but I have shared some with Sarah that can be shared after the webinar today. So very nice to meet you all. Thank you very much for the invitation to speak. I'm based over in London. I work for Climate Bonds, which is a not-for-profit. We are based in London, but we operate globally. And our mission is to mobilise debt capital in particular for the transition to a low carbon, climate resilient economy. And a large part of our work is setting trusted science-based frameworks and definitions of what actually is a credible climate investment, and use those frameworks and those definitions and those criteria to guide issuers and investors and assessors and second party opinion providers, all of that kind of ecosystem, and to also shape government policies to facilitate projects and programs that will build up a pipeline of those investments actually. So we start from the kind of definition space, but we actually apply that across catalyzing a labelled market and also catalyzing government policy that can really scale that market and scale finance. That's basically what we do. So we have been developing sector-based mitigation criteria and a mitigation taxonomy since 2012, probably possibly one of the earliest, if not the earliest people to develop the idea of a taxonomy and criteria populated within it. And since 2016, we've been engaging with governments globally to talk about the value of having a taxonomy at all, what they can bring to scaling sustainable finance. And we've worked specifically with more than 20 governments to date to develop their own taxonomies, including the EU, Australia, Singapore, Rwanda, Colombia, and we've advised on many more. So we're quite steeped in developing criteria for taxonomies and trying to apply them for the financing sector, essentially. So coming on then to our resilience taxonomy, our draft resilience taxonomy, which we refer to sometimes by the acronym CBRT, the Climate Bonds Resilience Taxonomy. We published it last September. It was in development for probably more than a year before that. What it is at the moment, it captures 1,444 resilience investments, which cross adapting investments and enabling investments, which might make more sense if you're across the EU taxonomy already, at both the kind of economic activity level and at more granular measures that you might implement within an economic activity to deliver adaptation, resilience, impacts and benefits. Those investments are organised into 25 sectors and 70 subsectors and grouped into 7 resilience themes, which include sustainable agri-food systems, resilient health, resilient infrastructure, resilient social systems, natural systems. All of those investments, we believe, do have the potential to deliver a substantial contribution to resilience. And we have drafted screening criteria to demonstrate in any particular case that a specific investment or a specific project would actually deliver that contribution to resilience. What we're doing at the moment is working to develop and finalise those draft criteria and to put in place an expansion of our certification scheme for labelled bonds so that we can certify bonds with adaptation and resilience components in their use of proceeds, essentially. And we're already seeing that is useful. It's useful as a kind of a shopping list of investments that can be used if people are looking to develop their resilience programme. Here's some ideas, for example, on what might constitute a resilience investment or a resilience action. If you already have a resilience program, it gives some guidance on what you might include in a resilience bond or any other type of finance for your resilience action, and the type of criteria that you might use to demonstrate the credentials of that action and that investment, if you're putting it in a labelled instrument, for example. Similarly, for investors, it can be useful to work out what to look for in respect of resilience investments. And we have had a lot of interest so far from assessors who might adopt it or use it. So consultants, for example, who have their their own methodologies for providing second opinions, essentially, and often they use our criteria as a basis for their own versions. It's kind of a foundation that is then tweaked and built on, etc., for more bespoke assessments. So it's had quite a few ripple effects already, which is really interesting. And like I say, we're working with a lot of governments globally around their taxonomies. In the main, that's been around mitigation, but some of those governments are looking to embed resilience in their national taxonomies. So we're working with those governments on that. So that includes, for example, Rwanda, Senegal, Laos, and a fourth one at the moment that we're working with too. And this is important for us because, yes, we've developed a taxonomy, but we really want to see this ripple out. And our taxonomy can be used on a voluntary basis, but if ours and other people's taxonomies, if we get to a kind of consensus position on these are credible investments, and then that can be amended and tweaked into a localized version for a local taxonomy, fantastic. So we're also doing a lot of work to try and propagate them out into local contexts as well. So I'll stop there for now, but that's a bit of an intro.
Thanks, Anna. One thing that you were touching on right at the end that I just want to highlight for everyone is acknowledging that local context and how integrating your taxonomy and working with local governments might bring up important local risks or needs. We talk a lot in the investing for adaptation and resilience space that it's so region sector dependent. What does it mean for adaptation and resilience, or what do countries need to become more resilient? And as you can imagine, a country with a lot of coastline or small island nations are going to really need different things than countries that are experiencing a lot of drought, for example. So just sort of hearing a little bit of that, I think we're going to touch more on the challenges of implementing these in that kind of regional context. So now we're going to shift from the perspective of sort of consultants, those who are developing taxonomies to use more broadly, to two fund managers that have explicit mandates from their own investment theses to invest for adaptation and resilience, who navigated these existing tools and taxonomies, developed their own, are continuing to navigate those over time and continuing to develop them over time. So first up is Lillian from Mercy Corps Ventures. There we go. So Lillian, Mercy Corps Ventures is one of the few funds that has this very narrow focus on adaptation resilience across your investments. And you've published your own framework, how you thought about this for the purpose of other fund managers and investors kind of understanding better what does it mean for Mercy Corps Ventures to invest for adaptation and resilience, but also how did you get there? So can you walk us through, just an intro a little bit to yourself and Mercy Corps Ventures, and how did you put together this framework? And also kind of where did it come from? I think that's an interesting piece. When funds have this narrow adaptation resilience focus, the answer tends to be that it was an internal investment thesis focus. So can you just kind of speak to that in your intro, and I will get your slides up now.
Yeah, perfect. Thanks so much, Sarah. Hi, everyone. My name is Lillian Alexander. I lead impact measurement and management at Mercy Corps Ventures. Just a quick overview for those not as familiar with us. We're an early stage thesis-driven impact investor focused primarily, as Sarah mentioned, on climate adaptation and resilience solutions, specifically in emerging markets. Next slide, please. Yes, just some quick background to understand where we're coming from. Mercy Corps Ventures has been investing for about 10 years now. We've invested in 58 companies who are collectively serving over 37 million customers across 87 countries globally. And while we invest at the pre-seed and seed stage, 82% of our portfolio companies have been successful in raising follow-on capital and scaling their impact. So we do have a unique vantage point of sort of being with the companies from the very early stages all along their growth journey. Next slide, please. So Sarah mentioned our investment thesis. We invest in three key areas under our resilient future thesis, including adaptive agriculture and food systems, inclusive climate fintech, and climate smart technologies. I've included on the slide here just some examples of the various types of sub-themes that we invest in under those very broad categories. And important to note that our thesis has evolved over the past 10 years of investing. We've learned a lot. We've made some had wins, had failures. We've had to evolve as the market has shifted. And when we published this current version of the Resilient Future thesis a few years ago, we wanted to communicate that regardless of whether we're looking at an ag tech, a fintech, or a climate tech company, all of the solutions that we invest in do need to contribute to climate adaptation and resilience for underserved communities. And we needed a way to determine the strength and the potential of that contribution, both to serve our team internally, really help to inform our investment analysis and decisions, and also to communicate externally to founders, to peer investors, and to our funders as well. Next slide, please. So how did we do this? We embarked on a pretty extensive research and learning journey to see what tools and frameworks already existed to help us with this. We did a lot of desk research, read a bunch of reports, attended webinars just like this one, or ones that we wish like this existed. We talked a lot to our peers, our ecosystem partners. We workshopped with our portfolio companies. It took about 2 years, to be honest, of lots of research and thinking to come up with where we're at now. And it is constantly evolving still. But what we learned from all of that is while there's a growing awareness of and interest in climate adaptation and resilience investing, there's also a lot of noise and confusion around what it is, what qualifies as an A&R investment, how is it measured. And secondly, we found that there were some resources out there. Mainly, we found from DFIs and governments, which were, great for serving that purpose, but were not right fit for pre-seed and seed stage startups that we work with. It just didn't quite make sense with, how early we're coming in and where the teams were at. So we needed a tool that made sense in the context of our investment thesis and the stage that we're investing. So we did end up building our own framework, but I'll say we leveraged a lot of the existing resources. We didn't come up with everything on our own. That was important to us to not contribute to the noise and just add one more thing in there. And we did, try to align a lot with what was already out there, but again, just sort of retrofitting that for early stage startups. And the point of this tool was to help us better identify, understand, and analyze the potential climate adaptation and resilience impact of the solutions that we're looking to invest in. So we have our investment process, and I think just asking the question of, is this a climate resilience investment, is not a yes or no question. It's not just a check the box or not. We really needed more understanding, definitions, taxonomy to help us to really determine what that means. Next slide, please. In the process of developing our framework, we quickly understood that climate resilience can mean so many different things to different people in different parts of the world. It truly is, as been mentioned, context specific, and there's not a one size fits all metric. And so quickly realizing that when people were asking, what's the one metric? What's the one metric? Saying no, there is not one metric was a good starting point. And we realized that we needed to break down a bit further what climate resilience is and where a potential solutions that we were looking at fits within the climate resilience cycle. We looked at the prepare, adapt, and recover stage. And again, this is language that is out there in existing, frameworks and tools and guidebooks. So doing so, and this is one of the steps in our 6-step framework, doing so helps us to really identify the specific route to impact for a potential investment opportunity. So we do that deep level of analysis. We chart out a theory of change for every investment we're looking at, and really understand how is this company's product or solution helping their end customers either prepare for, adapt to, or recover from climate related shocks and events. So we have made this entire framework public. I can share the link afterwards. I'll put it in the chat. And I'm happy to dive into specific areas later during the Q&A, but I'll pause there and hand it back to you. Thanks, Sarah.
Thanks, Lillian. We are now going to hear from Tara with the Lightsmith Group. So again, another investment fund who's had to navigate this very early on, developing taxonomies, pulling from different resources. So with that, and Tara, I will add your presentation in just a minute.
Perfect. Thanks. And I'll start with a quick background. Thanks, Sarah. I am Tara Gielig, the Director of Sustainability and Impact for the Lightsmith Group. And early on in I think, starting with sort of the origin story of taxonomies and frameworks, I'm happy to share that early on, as we were establishing our investment thesis, we realized how critical it was to have integrity to how we think about and define and categorize the kind of investments that we'll be making to support resilience. And part of that was, I think, for our own internal purposes, as well as, clarity for our LPs and investors. But the other piece of this is recognizing, if you flip the starting point and think about why is there such a huge financing gap in adaptation. So much of this relates to, the nuanced nature of these interventions and the fact that unlike if you compare this to mitigation, where there's a very clear metric for success, there's a very clearly defined set of assets, whether that's renewable energy or energy efficiency. Adaptation is much more, it's multi-sectoral, it's very integrated. And so we saw this as a barrier to mobilizing private capital in support of adaptation was this lack of boundaries of definitions around if you call it an asset class. I always say that adaptation is really a lens and not a bucket. But I think for the capital mobilization purposes, having some established approach is very helpful in really beginning to catalyze that sector. So if you turn to the next slide, I will give just a snapshot of Lightsmith. We are a private equity firm that's focused on adaptation and resilience. We closed on a $185 million fund at the end of 2019. And we are focused on growth stage companies. So these are companies that have already a proven product market fit, a proven concept, and are at the stage of growth where they are ready to scale. And part of where we see our value add is in bringing capital to expand into a range of geographies, including low middle income countries. And so to really put this strategy into place, we narrowed down into a set of subsectors. So we're focused on agriculture analytics, geospatial mapping and imaging, risk analytics, medical diagnostics, supply chain, support for biodiversity, water, and resilient food systems. And this was really the Venn diagram of what we saw as sectors having a pretty direct link to supporting adaptation and resilience products, solutions, or services, and those where we saw market potential at the growth stage. So typically our investment ticket will be between 10 and $20 million. And we are looking for companies that have at least $10 million in revenue. So these are larger companies. And if you go to the next slide, I'll share a little bit of background. The kind of definition of the approach began in 2020. We received a grant from the Inter-American Development Bank, and it was part of a larger project to try to create a system that supports SMEs in adaptation and resilience. And as part of this, we had an incubator strategy. We identified SMEs in a pipeline, and then we also developed the adaptation solution taxonomy. And that was specific to the program. So it was looking at SMEs in emerging markets that contributed to adaptation and resilience. And so that was really the first round that was published in 2020, utilizing a peer review process and building on existing frameworks and taxonomies. Then last year, one of the questions that we, continued to get was, well, what about companies that are outside of emerging markets? What about companies at different stages of growth? And what about different financial products or services that you want to use for these companies? And in particular, there was a question as to whether this taxonomy could be applied to a strategy that would be focused on publicly listed equities in adaptation and resilience. And so that was really our challenge, was to think about how do we mold this framework to make it more flexible to accommodate a wider range of potential opportunities to invest. And so we worked in partnership with the Bezos Earth Fund, with the Climate Works Foundation, and with MSCI to really revise the framework. And so I would say at its heart, the definition and the approach remain the same, but we wanted to expand and make it more flexible. And as part of this, MSCI, which has access to lots of data on publicly listed companies, they used a large language model to apply this framework, and they were able to discern a list of about 800 companies that they think fit within an adaptation resilience thesis. And so that was an interesting application of this. But essentially, as you've heard before, it's contextual, it's multi-sectoral, but really what we're focused on are either direct interventions that help to mitigate or manage the physical risks, physical climate impacts, whether those are to people and communities, whether that's to nature and landscapes, or whether that's to hard physical assets. We also wanted to ensure that we are capturing more ecosystem level impacts, so supporting interventions that help to address systematic barriers to adaptation, whether that's data or information or financial barriers, ensuring that those types of solutions can also be incorporated. And as I think Lillian pointed out, we wanted to make sure that the continuum considers impacts before, during, and after they occur, in the sense that you are preventing and preparing as well as responding and recovering. And ideally, I think all of us could acknowledge that the further upstream these interventions occur, the more likely you are to bend the path of decision making in a way that's more resilient, as opposed to everyone's favorite example of air conditioning, which by some reads would be a mitigating measure to climate, but I think we all realize the unintended consequences of that. So Sarah, if you flip to the next slide, I just wanted to touch briefly on the process that we implement internally. First and foremost, we are looking, when we look at a company, we're trying to see what's their geographic footprint of where their product and service is either currently being offered or in the near term is expected to be offered. And we'll look to see what are the physical climate impacts drivers in that geography. And so that could be heat, it could be drought, extreme storms, sea level rise, et cetera. And for that, we'll turn to an independent source, usually the IPCC reports. And then based on that, we will match the expected, the core business model of this company's offering to see how does this intervention either manage or mitigate or identify these risks. And then from there, and this table kind of explains this breaking out by intelligence and then physical products and services, and just gives you some examples in different sectors. And if you go to the next slide, Sarah, you'll see one of the really important things that we do as part of this process is we'll identify key performance indicators that we know that the company can report and track on. And so this really is fundamental to being able to support our theory of change. And so this is just a snapshot of the metrics that we'll capture across the portfolio. And again, this is a range of sectors from agriculture to water to parametric insurance. And so as much as possible, we want to have a standard systematic set of indicators that we tracked. Of course, there's nuance to that, but this just gives you a sense. And that's it for me for now. We can turn to questions next.
All right. Well, I get all of the panelists pinned up here. If anybody has questions, please put them in the chat. We obviously gathered questions when everybody registered, but definitely welcome any additional questions that we might have. Right. So the first question, I want to go back to both Tara and Lillian. You both spoke really well to how developing a taxonomy and implementing it is really integral just to the strategy of your investment fund. But the question is, were any of your LPs asking for any of this? And on the flip side, how do you explain this to LPs that don't necessarily have adaptation and resilience as a core part of their investment thesis or what they're asking for metrics for? So there's kind of two sides to that question. I think it depends on who your LPs are, which is definitely part of it, but would just love both of your perspectives on, yeah, navigating that LP relationship when it comes to reporting on adaptation and resilience in your portfolios.
Sure. So I think it is something that is just so core to really the value of our investment thesis as a starting point. We have a range of LPs, ranging from governments to development finance institutions to philanthropic capital to commercial investors and I would say of that spectrum, I would single out the UN Green Climate Fund as our LP that really it was really important to them that there was alignment on how we define adaptation resilience, not just internally, but in terms of an external verifiable methodology. And so we have developed an internal tool, which essentially is an exercise where we will look at historical climate data, future projected climate data, the geographic overlay, and then kind of describe more specifically the intervention and how that can support enhanced resilience and how that can be measured. So this is something that's very important to them. I think other investors are maybe more focused on the metrics, and they are, curious to be able to integrate the way we define it into their existing institutional approach. And so that is a sticking point sometimes, in that there's slight variations around definitions, but we want to make sure that overall we're really trying to measure the same type of impact. So hopefully we can get alignment and harmonization on the metrics piece. But it's certainly important. I think there's a range of where each LP will come at it, whether it's more on the classification side or more on the metric side, but all very key to the thesis.
Thanks, Tara. What about you, Lillian?
Yeah, I think echoing a lot of what Tara said, certainly all the LPs and funders always ask for metrics, but we have yet to have somebody specifically ask for the underlying taxonomy and framework. And for sure, there's a range depending on the LP of sort of what they're interested in. But we have proactively shared our framework with all of them, where we have discussions about every single investment that we make and how we went through it, and kind of use it to help spur that conversation if it's not necessarily already happening. I think at Mercy Core Ventures, we have a really strong focus on thought leadership and ecosystem building, and that includes our LPs and investors. So we're not necessarily waiting for LPs to push for something or ask for something. We'd rather be doing it ahead of time, get out ahead of it, but also because it's what makes us smarter investors and helps us make better investment decisions, whether or not somebody's asking for it or not. So
Thanks, Lillian. So this next question is kind of going to build off that and another question that came in through the chat, and this is going to be for both Morgan and Anna. So each organization here technically has their own taxonomy. There's a ton of overlap very meaningfully. I think that Lillian, you referenced that when you talked about developing your taxonomy, not trying to start from scratch or add to the noise of what does it mean to invest in A&R. And I think Morgan and Anna would love from your perspectives, what has that looked like in just knowing what other institutions are doing, trying to figure out how to, if not a future where all of these are merged and there's just sort of like an agreed upon taxonomy. In the meantime, how do they speak together? How do you sort of acknowledge where there is important differences or, yeah, can you just sort of speak to, we have these different taxonomies. I think if you're brand new to this space, you might be thinking, Oh, if I was going to start, I wouldn't even know where to start. But the truth is, there's a ton of purposeful overlap. And I think that the funds have taken fit for purpose for the type of investing that they're doing. So, Morgan and Anna, because you're on the sort of higher level side, you're looking at a lot of different financial products. Can you just speak a little bit high level to the taxonomies that you've developed and how they're different or speak to the other taxonomies out there, even that are on this call?
Yeah, I'm happy to start and then I'll pass to you. It's a great question. So, two thoughts. One on sort of process of how we tried to collaborate amongst ourselves, and then one on the output itself. So, I mean, in terms of process, one of the ways in which we aimed to align was just to be connected from the beginning of the development. So, in the last 18 months in the development of the taxonomy fit for the purpose of post-hoc tracking of private adaptation finance, the context that I was capturing, we're really engaged with the CBI team as they were developing, in the process of the CBRT and the taxonomy development that they had underway, and with Tara and the Lightsmith team, their taxonomy development had already occurred, but to be trying to be as thoughtful as possible about the development that had happened there to align, and the where we ended up was really pretty close alignment on themes, activities, the enabling versus products and services versus intelligence framing that Tara captured, and that is also pretty closely mirrored in the CBI work. And then what we aligned on in terms of the divergence was what are the real differences in the way we're trying to use these taxonomies, and where does that just substantially merit a different final product? And so, in the context of our work where we're tracking financial flows that sometimes just don't have this information, we need, for example, the adaptation likelihood measure that captures for us in the absence of climate risk information. If all we have is the financial flow, the sort of total aggregate amount and a bit of a description of what the financing was going towards and the date, we will need information on, sort of an ability to assess the likelihood that something is adaptation in the absence of that risk. For a bond issuance, and Anna could speak more to this, much, really different scenario where you have that context. You're not looking backwards at whether there was climate risk. And so that was how we thought about the divergence in these taxonomies was what is the use case and what are the necessary, therefore, divergences? And let's make that the only, as much as possible, the only point of divergence, and the rest, the sort of fundamentals of what we're talking about, be as similar as possible. But with that, Anna, over to you.
Yeah, thank you. Yeah, so just to echo that, definitely in the process, so we all speak to each other a lot. We have expert groups. So when I say CBI's taxonomy, it's not CBI that sort of develop, we sort of facilitate the process. So we had what we call the RTAG, the Resilience Taxonomy Advisory Group, and CPI and others are on it, and Lightsmith, etc. So they actually come in and we work very closely at the beginning to do it. And similarly at the end, when we have a draft, and over time as we have a more and more developed taxonomy, like I said earlier, we want to make sure that these are being used by as many people as possible. So we don't just put it in a box and it's our taxonomy. It's about embedding it into other people's taxonomies because we know other people will want to tweak them. So we're very involved all the way through the process with other people that already have taxonomies that are developing at the same time. And for example, when CBI did the first set of work before the taxonomy, we did something back in 2019 called the Climate Resilient Principles. That was at the same time as the EU taxonomy was being developed, and I was working across those two things. So those two things are very aligned. So there's a lot of engagement in this space, I think, to make sure we are. It's an interesting time because I think there is value in having slightly different processes developing taxonomies at the moment. I know it causes confusion, but they are always for slightly different purposes. So it's useful for people with a slightly different lens to think in detail about what they need for their use case and their purposes. And then what I think we do need to do, which we haven't done yet, is I think we can all agree and we can talk to the fact that yes, we've now all got the same pretty much consistent themes. We've got a consistent approach to different types of investments, adapted and enabling, for example. But can we go back now or in the next year or two and actually map investment to investment? Are we listing the same kind of things? Are we having the same kind of criteria, metrics, KPIs? I think that will be really important because at the moment it's a bit take it on our word that we're fairly consistent, actually showing that mapping from taxonomy to another. And that might be a stepping stone towards integrating them, though I don't think we need to do it. I feel like the mapping will be enough actually to demonstrate the alignment and where they're different and deliberately different, because in some cases they might be. We take a really broad definition of resilience, which moves us well into the kind of SDG space. And so we're going to be doing a lot of work on social resilience as well, for example, and gender inequality, and want to pull a lot into here, which some people might think, that's going too far. They might want to focus more on the kind of immediate impacts of the physical impacts of climate change and addressing that. So we've got that, but we want to do more. So there will be people who have different boundaries. And I think it's all about transparency, and we're doing that through talking. We haven't documented it yet, I guess, is where we are. So yeah, more to come on that one.
Thanks, Anna. I'm going to add a bit of a comment to transition to the next question, which will be for everyone. Something that I sort of picked up on, and I think Gary's work through the CRIS framework in partnership with Lightsmith, as Tara described it, emphasizes this as well, which is one way you can think about the use case for different taxonomies is, are they prescriptive or descriptive? So prescriptive is something that Lightsmith and Mercy Corps Ventures are using because it's focusing where they're going to put their money, what types of investments they want to focus on, how impactful are they? Are they impacting the target stakeholders or community in the way that fits the investment thesis, which is different from I really loved the intro to CPI's work, which is there's this universe of private sector investment into adaptation resilience. How can we find it? A lot of it, and Gary talks about this a lot, isn't labeled as adaptation and resilience. Maybe it's labeled under resilience to a specific type of natural disaster. Maybe it's, resilience to something like drought, but it's not being labeled as this climate adaptation and resilience investment. And so in that way, some of these taxonomies need to be just more descriptive so we can look into the investable universe, into the invested universe, and say what money has gone into this adaptation and resilience space. And I think that's one kind of interesting way to just understand, to Anna, your point as well, that it's really useful to understand where it overlaps and maybe even try to overlap it better and see if we're all tracking things the same, but also understand, Morgan, to your point, there's just a different use case, which is useful to know. And I'm really appreciating this conversation as well, that there aren't these little silos of investment all over the world with different investment classes where we're doing different things. We're really largely doing the same things and talking together, even if it's not fully being tracked yet. So the next question really hits on one of the core tensions in investing for adaptation and resilience, which is we don't have a simple metric like mitigation does. Lillian, I really appreciated that you emphasized that you'd get that question and had to just sort of repeat, there's not one. With that being said, with your experience, are there a few sets of metrics that you've just observed consistently come up, they're meaningful in tracking the impact that you're making through these adaptation and resilience investments? Even if it's not a perfect metric across the board, what are the metrics that you've observed are the most meaningful? And this is sort of for everyone, so anybody can chime in.
I think if you go to the starting point of who is really benefiting from these interventions, I think there is some consensus on it's individuals, it is nature, and it is physical assets. I've heard it described as people, property, planet, or a few different words to describe it. But if you start at that point and then you work backwards to think about in what way are they benefiting and how would you measure that? So for physical assets or property, you might look to see, value, enhanced resilience of the physical asset. For people, you could count individuals, you could count organizations or communities. I think, in the nature beneficiary lens, you could think about hectares of land or water. So just kind of as a basic starting point, if you think about the ultimate beneficiary of this intervention, you can sort of walk backwards in a way that is relatively uniform. And I appreciate your comment, Sarah. I think, when you think, oh, there are multiple taxonomies, it's such a fundamental difference in approach. I think that's really not right. It's much more that there are very practical realities. Like we might have to move on a certain timeline, or we have limited information about a company. And those are the factors that might be influencing the differences in the taxonomy versus a fundamental a difference in our approach on how we interpret what resilience is. So thank you for pointing that out.
Thanks, Tara. Anybody else want to chime in?
Yeah, just to say something very similar. So the way that we did it is similar to that, that we thought about when we think about what investments are going into the taxonomy, what is the intended resilience impact? And so in the construction of the structure for a taxonomy, we were thinking about what could those impacts be. And like I say, we take a very broad lens, so it's across the economic, social, and sort of environmental space. And it could be things that are impacting. It could be what's the hazard consequence? So is this coming from heat stress? Is it coming from flooding? Is it coming from a range of hazards essentially? So what's the cause? But what's the impact? Is it impacting on asset values or loss of revenue? So there'd be economic ones. Is it impacting on inequality, gender inequality, or for vulnerable groups? Is it impacting on populations, displacing populations? Because I think if you start thinking about the impact of them, exactly, you can think about, okay, what's the metric I need to measure? So there isn't one metric, but you can get targeted metrics that then simplify at least the discussion and around, okay, what can be a kind of meta indicator for that investment is helping to mitigate risks of population displacement. And then you can make sure you're actually testing the right thing. So and that's what we're trying to do with the taxonomy. And that's why the criteria part takes quite a long time, because you actually have to think, actually, for all these investments, let's be clear about what's the intended impact. And then what's a metric that's relevant for that impact. So we've started to define what those kind of metrics and indicators are. We haven't got the thresholds for all of those yet, so it takes longer, and we're going to have specific sectoral working groups to help us fill that in. What we've also actually tried to do is, based on the experience with the EU taxonomy, where it was all very process related, generated. So it was about, okay, do a risk assessment, work out what your primary hazards are and your exposures, etc., the ways that you're going to mitigate that, and that becomes the basis of eligibility under the EU taxonomy. We wanted to say, is there anything that you could say is a kind of no regrets resilience investment? And we've called those kind of whitelists. So we've tagged some investments that we think are kind of automatically eligible in a sense. So to try and take out some of this burden. So some don't need any metrics at all, is what we're suggesting, because they're kind of a no regret investment. So we've kind of siphoned those off, and then we can get to others which will have a more simplified sort of technical specification to the investment, and then some which will still be much more complex process-based assessments. But by trying to disaggregate it a bit and put them into different categories, again, just to ease usability for an issuer in the bond space, whoever that is, a corporate, a sovereign that is trying to implement resilience action and program, and the investor as well to evaluate it. So yeah.
Thanks, Anna. Lillian, I think you had a addition.
Yeah, just really agree with everything that's been said so far. And I think it's just important to emphasize that, yes, metrics are important. We need them at some stage, and it helps us understand, yeah, did this investment have the impact we thought it was going to have? And as both Tara and Anna said, jumping straight to the metrics is not the way to do it. Doing the work and really diving into what is this product or service? How exactly is it intending to improve climate adaptation resilience, for whom? And then metrics come after that. I think, yeah, just I'm an IMM professional, and I work in metrics all day, and even still, there's a tendency to kind of jump to like, how are we going to measure and what is it? And we won't have the right metrics if we don't do that work up front. And then secondly, especially for us, when we're investing very early stage, pre-seed and seed, it's a theory of change. It's a theory, right? We are trying to prove it, but it has yet to be proven. That's why it's a new company and it's a new product or service. So being open to and actually looking, not just collecting the metrics, but actually looking at what they're saying and what questions they're answering for us or not, what theories they're proving or disproving, and then going back and adjusting our assumptions and tweaking the theory of change based on what we're learning over time. is another important thing.
Thanks, Lillian. Morgan?
Very briefly, because there's a lot of good questions in the chat. One example of this that we see in the context of our work through the lab when we're supporting instruments that where the specific target is a investment in a product or service that's then being delivered directly to consumers and households is that we saw with some of those teams that actually their investees already were making a sort of metrics or measurement case or an outcomes case because it was the way that they were just marketing the product to consumers. And anyways, I think it's, it doesn't apply in all cases, but in the instance of an investment that is relatively direct to consumer, the consumers are, the farmers are already facing climate risk and are compelled by an argument of here's how we can shift your crop production, or this is how our intelligence service will help you in X way avoid losses. And so, just to say that look out for the cases where the metric has already been structured around the way that the product or service is sold, I would say.
Thanks, Morgan. I think this is a really good transition to what might be the last question. We might be able to squeeze in a few more. And please continue to add your questions to the chat. This is kind of an ongoing conversation that we'd love to be answering some of these questions potentially in another format. So if you have more questions based on this conversation, even though we'll be wrapping up soon, please include them. So my question, and Morgan, I actually want to start with you. I think an underlying question of why we're even having this conversation, which has come up here in the chat and some of the pre-submitted questions, is are these frameworks, whether specific to an investment fund or more broadly, as Morgan and Anna have described them, are they meaningfully moving more funds into adaptation and resilience? And there's kind of two sides of that. Is a fund that's implementing these taxonomies attracting new and different types of capital? Or in general, now that we have some focus of what does it mean to invest for adaptation and resilience, we do know that some governments, some DFIs, some private investors have made some commitments into this space. So does the taxonomy actually encourage some of that capital movement? And I know that this group we are not necessarily on that side of fundraising all the time, but I do think that because we're implementing the metrics or tracking them, like Morgan is, I think we do have kind of an interesting perspective, not a conclusion on that case. I think that some of the comments might be, we're still figuring that out, but would just love to hear from each of your perspectives what that looks like. Are you seeing more money? Does it matter maybe from a fundraising perspective? Lillian, maybe for you all, some of your LPs are more interested in just supporting the work on the ground. The A&R piece is extra, or maybe that's really what the LPs are looking for. So we'd just love a couple comments from each of you, where you sit in this universe, what your perspective on that is.
Yeah, it's a good question, and I think it's worth, but I'm glad for the skepticism or the, at least sort of the push from people about it. Two thoughts on how we think about sort of the theory of change of what taxonomy does. These are not comprehensive, but in the interest of time. One, the vision with the taxonomy and what it yielded in terms of our ability to track private adaptation finance is that insofar as we were able to track to more clearly track what already exists in the market, like I said, sort of in the initial framing, our hope is that that helps people understand and shift the narrative around the opportunity here, the sort of unavoidable opportunity in the framing of the Lightsmith team, and so that's the vision, is that one piece of the theory of change is we just need people to understand what already exists and to shift away from the framing of adaptation resilience is not bankable, there's no investment opportunity. Certainly there are pieces of adaptation resilience that will require substantial public finance, et cetera. And that was the goal of this work. So part of it was narrative based. And then the second piece, and it relates to our work in the lab and its sister program, the Catalytic Climate Finance Facility, is the ability to just sort of define and articulate a market and to go out to investors and to say, this is what we're hoping you invest in. And I think that was something that we saw for mitigation 25 years ago or 20, dependent on the exact amount of time. And we saw that be really meaningful in the way that the market built. And so, I think we're sold that there's a value in being able to describe what we're talking about. And I think there are other uses too, but I'll stop there.
Thanks, Morgan.
Yep. Maybe from climate bonds perspective, because we track the bond markets, and when you look at bonds at the moment, label bonds, so green, social sustainability bonds, it's actually quite hard to work out how much of those proceeds are going towards resilience projects because they're not always very well disclosed. But we'd kind of estimate around about 18%, so a small, relatively small fraction compared to what we know needs to be spent. So it's relatively low at the moment. We are getting people that are very interested in using the taxonomy, and from sovereigns. Sovereigns at the moment are the biggest issuer of bonds that relate to resilience by quite a long way. And we are getting some interest from some sovereigns to have bonds certified in the near future that relate to sovereigns. That's great. Whether that's additional, particularly from these early movers, you could debate that. It's probably programs that are already in train. But what we do see is often when people do start bringing these bonds to market, it encourages others to as well, and it can give people confidence actually. And I think that's really important. It's hard to quantify the additionality impact of that, but it's really important as this kind of ecosystem of finance and transparency around the finance and the underlying programs, the resilience programs that are happening. It really increases that through the green bond market because people have to disclose what the proceeds are being used for. So that's a really valuable benefit. And again, similarly for investors as well, we want them to put it just in their green mandates. Don't slice and dice it too finely. This is all green. It can be another way. What we see in the bond market is people want to see a much bigger pipeline of investments. They've got money to invest and not a big pipeline. So that's the message we're trying to take to a lot of potential issuers, sovereigns and others. There are investors with green mandates. If we can convince the investors through the taxonomies that these investments in resilience are credible, then actually we can tap into diverting that money that's ready to be spent into these resilience programs, which are hopefully going to be scaling up too. So that's our kind of theory in the bond space. Yeah.
Thanks, Anna. What about you, Tara?
So I wanted to kind of pick up on what Morgan said. 2 points. One is that I think there is a lot of activity that's happening that we have not been able to classify as adaptation and resilience. We might think of it as an agriculture investment or perhaps an infrastructure investment, and that as these taxonomies and frameworks evolve, there's the ability to kind of fold those into our fray. The other point I wanted to make is that I think there's also space in between sort of the policy level dialogue and what might be happening in the sense of if you look at the private commercial capital's interest in things like adaptation resilience, it might not be so explicitly stated. But if you say, well, we think there's going to be increasing demand for building material that's resistant to, moisture, or different types of seed varieties that can be, drought resistant. I think that is there's a fundamental driver in place there. Everyone maybe has heard Jayco say that we don't know, we have no certainty about interest rates or currency or the market or who Taylor Swift is dating, but we know that climate change is happening. And so from just fundamental macro drivers, I do think you're going to see more and more.
Thanks, Tara. Lillian, any additions?
I think similarly, as I said at the beginning, yes, there's growing interest and awareness. There is noise and confusion, but these taxonomies, these types of conversations, more and more investors, figuring out what makes sense for their funds and following up on that, tracking that, and generating the evidence and sharing it is definitely helping to tip the scales for those investors who are getting curious, dipping their toes, and, wanting to see some proof that this is indeed going to have the impact that they're interested in having, definitely helping to, slowly but surely bring in more capital.
Yeah. Thank you all. Just to wrap up, and thank you to our audience who stuck with us for a couple extra minutes. Just some conclusions that I think are really interesting here, which is in order to meet the demands for what a more resilient future looks like, it's going to take a lot of different types of capital, and it's a lot of different sectors. And it's really interesting to hear how these taxonomies that are trying to both track and direct capital into those spaces all really do speak to each other. And we're working on making sure they speak to each other better, making sure we're tracking things more in line. But also at the end of the day, it's meaningfully moving capital into products and services that we need for a more resilient future. And I'm at least really excited about the idea that there's more money moving into that space. Gary has started looking more into kind of the tech venture capital space that's not at all labeled as adaptation and resilience, but could be really meaningful in this space. That there's just a really interesting conclusion, which is if you're an investor who you know that the work that the investments you're making have a meaningful impact into the resilience of a specific community, of an industry, then that's something that you can start tracking and paying attention to, even if you're not labeling your fund as an adaptation and resilience fund. And even if that investment you didn't originally think of that way, this is something that we can start to track more of. And to what Tara said earlier, there's a lot more money going into this space, but it's being labeled as something different, maybe infrastructure, maybe sustainable agriculture. So I'm certainly encouraged. I really appreciate the expertise of all of my panelists who were able to bring such different perspectives from different angles within what it means to track investment into adaptation and resilience. And thank you to our audience for all of your questions. We do hope to have some additional follow-up from this session because I think this is a really important conversation, especially for private sector investors, to just continue to speak to each other about how are we doing this? What does it mean? What are our best practices? So thank you all so much for this. And this will actually go onto our YouTube channel, which I will post to LinkedIn and our website probably in the next week or two. So if this was interesting and you want to pass it along to some of your colleagues, other fund managers that you know are starting to navigate this, please go ahead and do that. We really want this to be a broad and useful tool. So thank you all.